As I said in my question, was that the models are okay, but you can't get the parameters, so you can't determine asset prices. We now come to Dr. Marek Muziela. He's the global head of fixed income income research and strategy at BNP Paribas. Part of his problem is to determine asset prices. So I think we're going to hear how, in practice, it's being done.
Control. Escape. Every single one is different. And that's the mind. This one, the last one. Well, first of all, thanks very much for inviting me to give a presentation on a topic that I'm really scared to say anything about. This is all thanks to Chris. And of course, the title, it's not that I can tell you what practitioners are doing with it. What I can share with you is what we modestly try to do. And this is not necessarily only what represents my thoughts, but thoughts of many people that work with me and for me in BNP Paribas in the group we call FIRST. This is the one. And that fixed income research and strategy team. So we cover 3 asset classes. We worry about foreign exchange, interest rates, and credit. But for a strange reason, I'm not going to talk about credit. And I have good reasons for it. I will comment at the end, but I just wanted to put in perspective, maybe to give you an overview over the last few years, what has been happening in the areas in which we believe we have relatively good understanding of what we are doing. So already there, you will see the challenges that lie ahead are phenomenal. So that's the reason why I didn't want to touch at all credit, because credit is a big mess anyway. So already we have many problems in traditional areas where knowledge of finance from quantitative perspective was generally accepted as decent. Okay. And to put it in perspective, I'm going to show few graphs and comment on economic cycles and how financial innovation followed economic cycles, and what problems with liquidity and modeling we were faced with over the years. And then I will point to a structural break that happened sometime in summer 2007 to the well-accepted wisdom of valuation that I still believed in the past worked, and I still believe will continue, if well understood, to work in the future. And if we have time, I will comment on counterparty risk and central clearing, the recent research that seems to be motivated by demands from politics and regulatory side to move away from OTC markets towards centrally organized markets, and make comments about whether this is a silver or golden bullet to solve the problems or not. And then I will finish by saying that I strongly believe that in the past, research in quantitative finance focused more on valuation, and now it has to focus more on risk management. And the two were before linked by the heroic assumption of market efficiency and the ability to think that you can link uniquely the notion of value with risk, that you need to, the self-financing hedging strategy. Okay. And because it is not necessarily as easy to accept this assumption, then I'll try to argue that what is fundamentally important, especially from the perspective of institutions that have legacy risks on their portfolios, is to focus on risk management. Okay? And the two, of course, are linked, but not in exactly the same way as they were in the past. Okay, so that's the general gist of the story. So economic cycles, financial innovation, liquidity, and modeling. So just very rapidly, we go through this to say that pre-crisis modeling methodology was more or less based on the argument that you could reasonably assume that there is a loose relationship between the hedge and the value. And if you manage to identify underlying assets that you could trade as defining major sources of risk in payoffs you wanted to price, then this methodology will deliver something sensible. And it actually did deliver for a very long time. And it actually worked relatively well in at least three areas: equity, FX, and interest rates. And it never worked in credit, because we never had this methodology in credit in the first place. Okay? We never managed to build a model link between assets that we use for hedging and distribution we use for valuation of CDO squares with some twists here and there. Okay? So that link never existed. And this is deliberately the reason why I didn't want to talk about it in here, not to confuse the issues. And another area which is also not very well understood is mortgages in general, where prepayment pollutes a little bit synthetic concept of valuation by arbitrage. So once again, I didn't want to talk about it. And of course, people wanted to do something in credit, and they did, copulous, and they used that. So we have to do something. Okay. Pre-crisis modeling for interest rate options. A lot of interest rate options were written on swap curve or LIBOR-related curve. So just for the record, LIBOR is London Interbank Offered Rate, calculated by BBA and then published daily. Okay. And in the past, and as you will see soon, it was, for good reason, assumed as good proxy for funding of banks. So banks could go to the market and fund themselves at LIBOR. And the entire industry has developed around this implicit assumption you can actually fund yourself at LIBOR. Okay. Arbitrage-free term structure models was, all of it, this technology took years and years to develop. It actually worked. Now, this is just a picture showing you 10-year US dollar 2-year, 10-year, and 30-year swap rates over time, starting from 1999 to 2009. And I show this graph for you to visualize it in 3 dimensions now, because somewhere they lost the 3-dimensional one. And it actually tells you that what happened after dot-com bubble, what Fed has done, lowering interest rates to, which button? Anyway, lowering rates to almost 50 basis points at that time in history. That's the short-term side of the curve. Then it started going up again. And then the recent crisis brought it down to almost zero, right? So you see on this graph that aggressive monetary policy of the Fed produced this type of shapes of short-term versus long-term interest rates. And of course, investors leveraged those investors that wanted to benefit from taking a view on what rates are going to do, would generate demand for certain product classes. Okay, so at one point in time, people believed that rates are not going to be too high, and then structurers and sales produced products that were betting on the level of LIBOR, in the future. Okay. Then, when the rates started to go up, people started to panic a little bit how it can go, but the long end went up, the short end stayed low, so people started to bet on the fact that maybe the curve is going to stay positive, it's not going to get inverted. So through the structuring, we moved from the situation where we sold to investors products that had coupon that was indexed on the level of LIBOR, to moved to products that had coupons that were indexed on the spread between 30-year and a 10-year, 10-year and a 2-year, okay? Always, and these are the simplest product you can possibly imagine, always referring to maybe at most 2 points on the curve, right? Maybe 10-year minus 2-year, okay? Now, this was going on for quite some time. This is just to illustrate. It's wrong because this finishes in 2008, December. Recently, as you know, for the last few months, long end shoot up phenomenally. So this is a comparison between 2003 and 2008. Rates are more or less much lower, okay, than they were in the past. Just to put things in perspective. And at the same time, this activity of selling products build concentration of risk in books of dealers. Okay, so people in fashion type of way, in certain period of time, reflecting part of the economic cycle, were capable to sell certain products more than other. Okay, and as a consequence, certain risk got put on books naturally. What happened after Lehman collapsed is that people started to really worry. So the volatility shoot up, okay, and there were two things that were playing at the same time. People had to hedge at much higher volatility level, often exposed to negative convexity, on products that were kind of not so complicated products to worry about. And also hedge funds tried to benefit from it. So there was like the machine to increase historical volatility, which was later followed by increase in implied volatility. Okay. Implied volatilities follow. That's the graph of implied volatilities. Okay, comparison here. Where do we stand? We don't see the bottom of.
Back to full screen.
What happened?
Yeah.
I'm not a PowerPoint.
Oh, yeah. So this is again 19th of December 2008 compared to January 2006. Okay, so you see that implied volatility massively moved up in recent time. Now, Pat knows it best. He's somewhere here in the audience. Pat developed a formula for so-called Saber model. And that model has been used more or less as a benchmark for giving quotes on caps and swaptions volatilities. The market today uses Saber formula for quoting caps and swaptions. But with this is like CEV type of dynamics with stochastic volatility on top. If you want to calibrate this to the market prices, you may have choices to make between the power that you have in the CEV, let's call it beta, and then correlation parameter between the two Brownian motions and some other parameters in the model. But you see, the bad thing about the model, especially in the regime of low interest rates and high volatility, is that the model has an incentive to hit zero with high probability, but when it hits zero, it stays there. So in the environment as today, when interest rates are low and volatility is high, the likelihood of hitting zero is high, so it actually complicates quite a bit the sensitivity analysis. The risk is complicated. Right. Now, so you could think that there was an arbitrage, and there were days in December and later in January and February and November as well, that when you looked at use your favorite model to calibrate the market, you could think that you could actually statically arbitrage the market. So it would be a great credit for the arbitrage-free models. You look at the market, you try to calibrate, it doesn't calibrate, you remove a point, you recalibrate it, does calibrate, you try to think about how you should trade the position to actually benefit from this apparent arbitrage. Well, if you could hold it for 10 years, you probably would. But the point about it is that you would never be allowed to do so. So this is one of the challenges also for pure research, more academic research. What is the weaker version of a notion of no arbitrage? That is an arbitrage that even if you identify it mathematically speaking, you will never be able to execute anyway. And then as a consequence, potentially you should exclude it as a notion of arbitrage. Okay? And to me, I was surprised to see that models didn't break. They actually showed something happening. We cannot benefit from it, but still they displayed excessive levels of volatility, and you could actually read it from the quotes. Now, all of it was like a story of the past, okay? That I wanted to finish with the comment, it's not so bad, okay? Because at the end of the day, even if in distressed markets, models kind of performed, okay? Kind of performed. There was an issue, of course, because now you have to answer the question, what exactly do you mean by models? Okay. Well, we didn't use typically our favorite term structure model to price the structures for a simple reason. You needed to reflect marginal distributions of the 2 points, say 10-year and a 2-year, and if both were Saber-like, required stochastic volatility, so your LIBOR model would have to have sufficient flexibility on stochastic volatility side. So you could cut corners and so on. But if you understood correctly what you're doing, these things worked. To me, they worked actually in the very distressed situations. Now things started to become interesting in summer 2007. In summer 2007, the historical relationship between the level of OIS, overnight indexed swap, and of the LIBOR broke down. That is, as you can see here, before there was a constant spread, and if there was a move of 1 BP size, then it actually was a big news. Okay? This refers to the notion that in the past, the assumption that the bank can fund themselves at LIBOR in the interbank market worked. At the marginal extra premium, that assumption was actually correct. Right? Now, you have a plot here of 6x9 LIBOR OIS spread. I show it in forward terms just to expose the issue a little bit more. And then you see what happened. The spread, this is euro 1 is dollar. The spread started to move very, very significantly and become ridiculously high. Like at one point in time in December on dollar, it reached 120 basis points. Yes?
Question, could you say, when you say lending became commoditized, what do you mean by that, and what is an OIS? What is OIS?
OIS is overnight indexed swap, and what it means is that people had to seriously think where they will find the money. The banks had a difficulty to raise cash, and the typical situation that you would go to the bank, to the market and borrow money at LIBOR from the market was no longer true. And different institutions, under different level of stress, had to pay more to access cash. Some of them ended up taking it from the governments. Okay? But funding in the open market is no more the same that it was in the past. It's no more the same. Okay? And now Now, the issue is the following. Okay, how much we depended on the assumption that the spread between LIBOR and OIS is more or less fixed in our thinking about models. How much we depended on it, and how we are going to incorporate in our thinking about pricing and models the fact that this assumption is no longer true. Right? You see, this this brings another concept which kind of got forgotten in financial mathematics completely, and even for us, for research, we never thought about. That is how it actually works in practice. So, in interbank market, people deal with each other in often collateralized terms. That is, when you trade with a counterparty, something, and the value is against the other side, you have to post collateral with this counterpart. That is, this example says, imagine that you have to repay someone $1 in the future, right? So you owe that party something. So you have to post collateral. That collateral will be less than $1 that you have to repay. And that collateral will earn interest rate until the time it will be repaid back to you. Okay. Now the point about it now is that interest rate that the collateral will earn refers to overnight index swap. It does not refer to 3 months LIBOR. So on collateral side, you compound at OIS, and on the other side, you have the funding curve that is related to LIBOR. Okay? And the two are not the same. And the two are not the same. There's many, many complications. I talk here about the simplest possible example of posting cash collateral. But typically, CSAs, and we'll talk about it a little bit later. So, this is more or less what I wanted to say. If we, we're almost done. If we want to value a simple trade, we just have to discount it to today. Okay. This illustrates that the present value of the two sides will be identical only when the O, which is our OIS, and the LIBOR are the same. Typically, you will have the discrepancy in PV on both sides. Okay. Now, actually means that you have to take it into account in quotation, in who is the counterparty that you are dealing with, in just about anything you do. Okay. That it actually means that there is no more possible to assume that there is one discount curve that markets agrees on and trades around that, and the future value of cash flows can be discounted with respect to that. The concept of relying of LIBOR-based discounting is gone, and it has to be replaced by something else. Right? It has to be replaced by acknowledgement of the fact that you would not use the same discount curve for all counterparties, that you have to dig into CSAs, see conditions under which this credit credit support annex, but this is not in this part. Credit support annex gives you conditions under which you can post assets. So banks trading with different counterparties signed over time CSAs that have different nature. They represent more history of what happened in the past as forward-looking way of thinking about what is the rational condition for posting collateral. So typically, collateral that we post refers to good quality securities. It could be cash, if it is with the US banks, treasuries, or tips. Now, for the record, recently we had such situation, and depending on what would be posted, it would cost us somewhere between 20 basis points and 45 basis points, so 25, 45 basis points, almost the double. Cash would cost more than it would cost in providing something else, in terms then. Right. So, excuse me, this actually means, thank you very much. This actually means that we have to go back to the basics. Maybe I should go all the way to the end. Uh-oh. That was the end. Okay, let's stop here, and I'll just say the following. The gist of this presentation was the following. In difficult times, generally accepted methodology of thinking about finance from quantitative perspective worked, even in difficult times. Okay? It means that it is likely to stay here, this methodology. That is, the concept of valuation by the idea of trying to replicate liabilities by trading certain assets that affect the price. That is going to stay. But certain fundamental rules that existed in the past are no longer valid. And we have to go back to Finance 101, essentially, and answer a question: what do you mean present value of future cash flows? If present value doesn't mean the same for everybody in the market. Okay? And what it actually means from the perspective of the theory of arbitrage pricing. Just for the record, swaps are collateralized, exotics are not. So replication argument makes reference to collateralized assets that we use for hedging to offer products that are uncollateralized. As a consequence, what is the forward rate underlying the option is not necessarily what you think it is. So at the money vol is not necessarily also the at the money vol you think it is. So there is all these things that need to be seriously taken into account. And of course, nothing can happen just like that overnight. And some institutions started to look at it seriously. I think it will take years before we get out of this mess, more or less. And I haven't touched the credit, okay? So the idea was not to touch the credit. We mentioned already that the situation in credit area is much more complex than it is even in here. It is much more complex. Thank you very much. Sorry.
Dr. Musiala, thank you very much for that. We don't know what the discount rate is. Questions for Dr. Musiala? Yes.
Yes. Since the worst days of the crisis, the spread between LIBOR and OIS spreads has come down quite substantially.
Yeah.
To what extent has that made the problem go away, or are people thought, well?
Actually, I had a slide that gives this in terms of forwards. Maybe we can bring it up if I know how to. Oh yeah, there is something happening.
Marek, could you just repeat the question so everyone can hear?
Yes, I will repeat it when I find the graph. Okay, so the question was, what, in a sense, implicitly, if I understand your question, it is asking the following. Is it likely that ever we are going to get back to where we were? Okay. Is it likely, and when, if ever, we are going to get back to that state? Well, this is my personal view. We go through the period in history in which financial market is being polarized on institutions that have good chances to come out of it stronger, and on institutions that actually will get hurt and will have to change their business model. there are forces in the economy that seem to indicate that if it comes back, it is not going to be tomorrow. The graph here shows in forward terms for 2011 what market expects on OIS LIBOR spread on dollar, euro, and GBP. Okay? So it was like 2 basis points in the past. Okay? And we have to, well, of course, this is a market forecast. So you may say, okay, well, they got it wrong again. But still, it's true. It was like at 120 in the midst of the crisis, and it came down, and it keeps coming down. But the real reason to worry about is this polarization of financial sector and potential impact of regulation that actually will probably remove some of the apparent efficiency that existed by the fact that hedge funds were not regulated in the same way as banks were. And I just see natural forces to make sure that it is not going to happen. So you will see it at the level of CDSs for those institutions. Those that will be good quality CDSs will be on the one side of the story, and then there will be the other side with credit picture, which is much more complex. And as a consequence, let's not forget, LIBOR is the average. You don't want to average 10 and 1 to come up with 5.5 and say that's the rate at which you fund yourself. Okay, so you need to have a population of institutions that contributors that actually provide sufficient liquidity and actually have quality of CDS that is comparable, I think. Yes?
So you're saying if you have illiquid assets on your books that you can't put on the marketplace, and surely you have to mark them at your own cost of funds, which means on your books you actually have your credit spread wrapped up in your valuation. You actually have a put on your own debt.
Yeah, but that's, you see, that once again, it's a management decision. Various institutions, I understand, approach this problem very differently. That is essentially to say the following, that you do not assume, you may assume that you are going to default on someone in pricing, or you may take an assumption that you are not going to take your option to default on someone, your own option to default on someone in pricing. Okay? But now, going back to actually what was observed pre-Lehman, you could see that there were many pricing disputes, maybe not necessarily immediately related to the quality of your CDS, but to the worry what will happen with the institution. And I would imagine many people that work in finance industry in the city seen disputes accumulate prior to major credit events. Disputes on valuation, because collateral posting in particular has to do with the ability to agree between the both parties on the value. But if you say you owe me 50 and I say I owe you 50, or vice versa, what do? We have to agree what is the...
That's true. Assets are held for trading assets, but on your held to maturity, on your not for sale assets.
That is on banking book assets. On banking book assets.
Yeah, surely on your core capital, you have to discount that at your cost of funds, which means as your credit spread widens, the value of your assets have to go down, which means that minus.
I don't know what industry does in this regard, to be honest. I don't know is there a standard solution to answer to this question?
You're referring to the liability side, Jen.
Well, exactly.
The asset side.
This quarter, there are going to be some really bad bank losses because the liabilities are worth more as the credit spreads have come down.
But that's for liability.
Nevertheless, the banking sector went up.
That's right. Because last quarter, all of Bank of America's profits.
I see another great subject for debate opening up here, and I think we better cut it short so that we can get on to the program. Dr. Musiala,